This is Barry Knapp with Ironsides Macroeconomics. You'll be getting this audio summary and video on Monday, October 18th. I'm recording it on Sunday night, October 17th. S&Ps are down 8.5 handles currently after the ferocious two-day rally at the end of last week. This week's note is titled Power to the People. It was a reference to labor share of income and the momentum we see in wage growth. There were 5 sections to the note this week. It was a pretty meaty report. The first section was titled Back to School, and that's a reference to the retail sales report, as well as us checking ourselves on our correction call. We'll come back to that. The next section was a review of last week's inflation data. The next section was Power to the People. This was our discussion of the labor market and wage growth and how the power is shifting from capital back to labor. The next section was called Stagnothing. That was us calling BS or baloney on this talk about stagflation. And then we wrote some introductory or early thoughts on earnings season, which was primarily almost exclusively financials last week. So on the back to school, we had written a couple of times recently, including after last month's, the August retail sales report, that we didn't think there was any serious growth slowdown. People get carried away with these tracking estimates of GDP. Sure, there was some slowing of activity in part because of supply chain disruption. There had been no demand destruction in our view. Underlying core demand was strong, and that would likely become evident. Certainly 2 very strong retail sales reports in August and September tells you back to school selling season was robust. That has historically correlated very well with holiday sales. And despite some issues that will linger with supply chains and product availability, we expect a very strong end to economic activity in terms of consumer spending through the end of the year. As far as the market call goes, we made our call for a 10 to 12% correction during the summer for a big rally in rates. We thought we'd have our 6th consecutive significant move higher in 10-year yields in the fall. And on balance, the call has worked out reasonably well. The S&P has been down as much as 6%, so we haven't gotten to the 10 or 12. We have the sectors, though, that we suggested taking risk away from: small caps, industrials, materials, did have fairly significant drawdowns. Tech had an even slightly larger drawdown. Our regular readers know we're market weight there. The sectors we wanted you to hang in with, financials and energy, have performed well. And we have gotten the big move higher in rates. So on balance, the call's been pretty successful, but we do have to admit at this point, we're about 6 weeks into what's typically a 60-day process when the Fed starts normalizing policy. We haven't resolved or totally priced that. We haven't seen the move we expected in fixed income vol, despite a significant move higher in rates. We still have 10-year real rates or TIPS yields near historic lows. So we still think there's more adjustment to be done. You can see from our Fed policy proxy, that'll be our first chart in the video today, that we've moved expectations of Fed rate hikes up fairly significantly. So this is a lingering issue. We still have no resolution about tax policy. We suspect right now investors are starting to think that the human infrastructure plan might fall apart, meaning that you won't get corporate tax hikes. We don't think that's the case. We do think that ultimately the Democrats will get something done, and that will be, from the perspective of an equity investor at least, fiscal policy tightening. Liquidity is going to start to tighten further as the Fed or Treasury starts issuing securities. Now that we have a debt ceiling deal done, we still haven't seen our net revisions indicator bottom out. So none of these things have resolved themselves. But down, having gone down 6% and having gone through 6 weeks of what's typically a 60-day process, we have to admit that risk reward for someone who can be patient and think about this in terms of over the next year or 18 months, the risk reward is more balanced than it was late in the summer when we made the call. So all that said, we still think we'll ultimately get the 10 to 12% correction, but we would not be reducing risk from here. And if we do get any kind of a drawdown, that's the point where we'll look to re-engage in the market. So that's it on that call. As far as the inflation outlook goes, coming on the back of last week's inflation numbers, the August and September CPI reports were very similar. You saw deceleration of reopening related sectors. So airfares, lodging away from home, and used car prices are coming off, but it's broadening out. And we're seeing it in supply chains. We're seeing new car prices and appliances and all the areas that were largely attributable for 3 decades of disinflation. We think those are the areas that we're not going to get the disinflation from through the 20s. And that'll be the reason why inflation is stronger. You can also see the effect of policy. This idea that a lot of Fed officials have leaned on, that this is a supply shock and monetary policy can't do anything about it, is again baloney. They are spurring demand in the most interest sensitive sectors. That's how monetary policy affects the economy. So housing and autos, durable goods, things that people buy on credit, those are supply challenged, and the Fed, by virtue of holding real 10-year yields down around negative 100 basis points, are stimulating demand in those areas. So policy is exacerbating the supply chains and price pressures and making things worse. So nothing we saw in the inflation reports, including the missing PPI, which was attributable to airfares, leads us to believe that any of these pressures are easing. In fact, you could see in our correlation and volatility indices that those pressures are moving higher, and in fact, those price gains are broadening out. So that's it on inflation. There's no real relief there. The next section we wrote about was our power to the people section. And after the last week's JOLTS reports, that again continues to show a big gap between the amount of jobs that are out there and the hiring that's being done, our measure of labor market fluidity or turnover reallocation, which is the quarterly sum of hiring plus separations, is going up very nicely here. And in fact, we have the quits rate at an all-time high. This is a labor market that where the power is shifting back to the workers. You can see it in strikes. You can see it in the administration's interventions into dock workers. The power is shifting back. And you'll see in our labor share of income chart that it bottomed 5 or so years ago, and it's moving up. It spiked during the pandemic. That's a little misleading, but it's in a trend going higher. And we do think over time, labor is going to take a bigger share of income. That'll eventually be a problem for profit margins. But now with demand as robust as it is, we're again in the reflationary sector, or we're moving into a reflationary regime, not a pure inflation wage price spiral. We could get there, but we're not there yet. So moving on to the section we titled Stagnothing, we wanted to make the point that what stagflation really was high unemployment and high inflation simultaneously. We have 2 charts to share, scatter plots to show you. One is the Phillips curve during the 2010s, which was alive. Yeah, it points, the Fed described it as flat. It was flat in the middle of the business cycle to an extent. The issue is that most economists make an assumption that wages and consumer prices are the same thing and they will always move together. They didn't move together in the 90s, O's, or 10s because of the China shock, the massive global labor supply, increase in the global labor supply, and that broke down that relationship between wages and consumer prices. But as we get to the end of last business cycle, wages did indeed move up. So the 10s, there was no evidence of any kind of even stagnation, really. In the 1970s, you can see this simple Phillips curve chart, and it looks like nonsense, right? I mean, you had very high inflation, very high unemployment, no clear pattern. That was a wage price spiral when things got out of control. We're nothing like that right now. We have unemployment going down, strong demand, and we have inflation moving up. That's what happens in the reflationary stage of the cycle or in a reflationary regime. So that's it on stagflation and calling baloney on that one as well. Seems to be our theme this week. Finally, on earnings season, we were a little bit surprised about how well the market reacted to financial sector earnings on Thursday. Not the JP Morgan numbers on Wednesday, but on Thursday when you got Bank of America and Citi and Wells. The market took that exceptionally well, and we were a little bit surprised because there was nothing in there that was much different than the last couple of quarters. No real evidence that a steeper yield curve is impacting net interest margins. Brian Moynihan did say, yeah, if the yield curve shifted up by 100 basis points, that would give us $7 billion in extra income, but it hasn't shifted up by an extra 100 basis points. Loan growth is improving, as we said it would be, but most of the improvement in profitability did come from the credit cycle. Now, there is the one piece of good news that return on equity is at 13%. That's a post-global financial crisis high, and that is good news for financials, particularly considering how cheap they trade. We have a scatter plot here we can show you of banks and return on equity. They're about, on a price to book basis, they're trading at about 1.4 times book. At this level of ROE, they should theoretically be trading at 1.6 times book. That's 20% upside for the S&P 500 banks index. So we still like the sector. Obviously, there's a couple of big regulatory decisions coming. One is whether they deal with the supplementary leverage ratio and start exempting reserves and perhaps treasuries again. That would be good news. But there's also talk about them increasing the counter-cyclical capital buffer that would lock more capital on balance sheet, degrade profitability. We don't think it's needed or a particularly good idea, but that could be an offset to any loosening of the SLR requirement. So that's it for me this week. Again, we still don't think these macro issues have been resolved, but the time is running short for a correction this year. We'll see if the market comes unglued in the next couple of weeks. If not, then what we're probably looking at is a rockier start to 2022 and seasonality starting to kick in, and the market, at least trading in a range through the balance of the year. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.